Hi, I'm Kara Murphy, and this is Money with Murphy. Over the past several weeks, conflict in Iran has escalated, driving oil prices dramatically higher and introducing more volatility to both stock and bond markets. Despite this volatility, though, it's important for investors to understand the longer-term economic fundamentals. So let's start with oil. A barrel of Brent crude oil spiked from about $70 before the conflict began to a high of over $110. At the same time, American consumers will have noticed that a gallon of gasoline surged from just $3 to nearly $4 a gallon on average. And in some states, that number is much higher. These higher gas prices have started to impact consumer behavior. Some credit card data suggests that lower-income consumers have begun to pull back on spending, and sentiment overall among consumers has dropped. Meanwhile, central bankers around the world are also becoming more cautious. In just the last week or so, the Federal Reserve, Bank of England, the European Central Bank, and Bank of Taiwan have all shifted from favoring lower interest rates to either being on hold or even considering raising rates. While these costs certainly hurt, there are some caveats. Futures markets are suggesting that that same barrel of oil will cost just $80 by year's end, an indication that market participants think this disruption to the oil market will be relatively short-lived. For the U.S. economy, how long oil prices stay high will be more important than how high they reach on any given day. However, there are several reasons to remain optimistic. The U.S. economy is much more energy efficient and independent than in the past, as energy costs represent a much smaller share of household spending than they did during the shocks of the 1970s. In fact, over the last 50 or so years, the U.S. has swung from a large net importer of oil to a net exporter of oil. Despite these headwinds from higher oil prices and the very real human cost of conflict, American companies continue to grow earnings. In 2026, companies in the S&P 500 are expected to grow earnings by about 16%. More than half of the companies in the index are expanding margins, and meanwhile, free cash flow margins are among the highest that we've seen. We can also learn from how markets have reacted to other conflicts. In short, the market reaction tends to be short-lived. I shared in another recent video that across dozens of major geopolitical shocks since 1940, the S&P 500's average return just 1 month after the event is roughly flat to slightly negative. By 6 to 12 months out, average returns have turned positive, and by 2 years out, markets have been higher in roughly 70% of cases, with average returns ranging from about 12 to 17%. Long-term investors tend to get rewarded for their patience. That said, this kind of volatility makes investment discipline more important than ever. Diversifying among asset classes can help cushion day-to-day moves, and focusing on long-term fundamentals can help keep investors pointed in the right direction. We'll continue to monitor this situation, and until next time, invest wisely and live richly.